Hello everyone. In this video I will demonstrate goodwill measurement and impairment when there is a non-controlling interest. In this example, Complete Company acquires 60% of the outstanding shares of Partial Company by paying $1.2 million in cash. The fair value of Partial's identifiable assets and liabilities is $2 million and $5 million respectively. So we need to determine the possible amounts at which Complete Company should recognize goodwill from this business combination. So there are two alternative treatments. I'm going to start with alternative 1 to begin. So with alternative 1, we need to measure the non-controlling interest, which used to be called minority interest, by the way. That's measured at the proportionate share of the fair value of the acquired firm's net assets. So this will be on the basis of net identifiable assets. So as the term net suggests, we are going to have to subtract the identifiable liabilities from the identifiable assets. So the net identifiable assets will be $1.5 million. We're going to calculate the non-controlling interest by multiplying the $1.5 million value for net identifiable assets times the non-controlling interest percentage. That represents the portion of the company that was not acquired by Complete Company. And so that percentage is 40%. So $1.5 million of net identifiable assets multiplied by 40% equals $600,000. So to calculate the goodwill under alternative 1, we start off with the consideration that was paid by Complete Company, which was $1.2 million. That was what was paid to acquire 60% of the outstanding shares of Partial Company. Then we're going to add the non-controlling interest that we just calculated of $600,000 to get a subtotal, which is the sum of the consideration paid and the non-controlling interest. So that's, again, $1.8 million. Then we subtract the fair value of the net identifiable assets of $1.5 million to obtain goodwill of $300,000. So that's alternative 1. The other alternative, alternative 2, is to calculate the non-controlling interest on the basis of the implied fair value of 100% of the acquisition target. So in other words, given that Complete Company paid $1.2 million to acquire 60% of the shares of Partial Company, how much would Complete Company have paid to acquire 100% of those shares of Partial Company? Well, we can take the $1.2 million in cash paid for the 60% of the shares and divide that by 60% to get the implied fair value of 100% of Partial Company. So $1.2 million divided by 60% is $2 million, which is the implied fair value of 100% of Partial Company. Then we multiply that $2 million by the non-controlling interest percentage of 40% to calculate non-controlling interest of $800,000. Then to calculate goodwill, we again start with consideration paid. We're going to add the non-controlling interest of $800,000. We get our subtotal of purchase consideration plus non-controlling interest, which is $2 million. And then we subtract the fair value of net identifiable assets of $1.5 million to obtain goodwill of $500,000. So this goodwill of $500,000 is comprised of the $300,000 purchased by Complete Company plus the $200,000 attributed to the non-controlling interest. Let's assume that Complete Company measured the non-controlling interest at the date of the acquisition using alternative 1, namely the proportionate share of fair value of Partial Company's net assets. Complete Company has determined that Partial Company is a separate cash-generating unit. And so at the end of year 1, Complete Company determines some estimates for Partial Company, such as fair value of $1.9 million, cost to sell of $20,000, and the present value of future cash flows at $1.86 million. What would be the impairment loss, if any, that would have to be recognized in the year 2 consolidated income statement of Complete Company? And what would be the amount at which Partial Company's net assets, goodwill, and non-controlling interest would be carried in the consolidated balance sheet at the end of year 2. So how do we determine this impairment loss? Well, what's the carrying amount right now? It amounts to $1.8 million. That's composed of the net identifiable assets of $1.5 million plus goodwill of $300,000. Then, of course, there's the unrecognized non-controlling interest as if alternative 2 had been applied. So when non-controlling interest is originally measured at the proportionate share of net assets, which was the case in this example, the carrying value of the entire cash generating unit must be increased by the amount of goodwill attributable to the non-controlling interest as if alternative 2 had been applied. So that's what we have done here. So the unrecognized non-controlling interest is $200,000. We end up with an adjusted carrying amount of $500,000 for the goodwill and total of $2 million for the adjusted carrying amount. So now we need to determine the recoverable amount. So how do we do that? Well, we need to figure out the fair value less cost to sell. $1.9 million of fair value minus $20,000 for cost to sell equals $1.88 million. We compare that with the present value of future cash flows of $1.86 million, and from there we determine the recoverable amount, which is the higher of those two figures. So in this case, the recoverable amount will be the fair value less cost to sell metric of $1.88 million, which we subtract from the adjusted carrying amount of $2 million to end up with our impairment loss calculated as the adjusted carrying amount less the recoverable amount and equaling $120,000. We next have to determine how to allocate the impairment loss. In this case, all of the impairment loss will be allocated to goodwill because the original amount of the goodwill recognized is greater than the impairment loss. Because partial company is a cash-generating unit, the impairment loss will be shared between the controlling and non-controlling interest. As a result, $72,000 of the impairment loss will be allocated to the parent's investment in partial company. That $72,000 represents 60% of the total impairment loss of $120,000. The remaining $48,000 of the impairment loss will be attributed to the non-controlling interest and will not be recognized by complete company. So the goodwill carrying amount after the impairment loss will amount to $228,000. The journal entry will include a debit to impairment loss of $72,000 and a credit to goodwill for $72,000. The consolidated balance sheet at the end of year 1, which are amounts related to partial company, will be net assets of $1.5 million, and again that's net identifiable assets, goodwill of $228,000, and a non-controlling interest of $600,000.